It has been 10 years since our last stock market crash, and for those who have studied the stock market history, they will know that there is a pattern of a stock market crash occurring around every 10 years. Now that begs the question, well, should we be investing our money into stocks, or should we put it all into cash and wait for this next market crash until stocks are cheap again? So in this video, I'll show you what returns you can expect with regards to owning stocks versus owning bonds and cash in the long term. And I'll show you what I personally think the smartest thing is to do with regards to this question. And we're going to look at what the investing experts are doing with regards to buying stocks or not choosing to buy stocks. So the first thing that we need to really think about is the different options that we have available with our money. So I would essentially say there is 4 key places you could put your money. So you can of course put it in gold, cash and bonds, stocks, and then real estate is another option that you could take. But personally, it's not my expertise. And also, it's really hands-on if you invest in real estate. It's a lot of extra work managing tenants and all of that. So we're not going to focus on real estate in this video. We'll focus on the other 3. So if we look at gold, it's really what's known as a hedge. For example, often when stocks are struggling and there's a recession or something like that, gold holds its value and often increases in value because people rush to safety when they panic. They want safe investments, and gold is known as a safe investment. But you really only want a small portion of your portfolio in gold, because gold, it doesn't really do anything. It just sits there and you just have to hope that people will pay more for your gold in the future. It's not producing anything. So that leaves us right now to either go into cash and bonds or to go to stocks with the money that you have. So the next question that you need to ask yourself is, which investment out of these 2 is going to give you a higher yield over time? Cash/bonds or stocks? So I'm going to answer that now. And the tactic that I'm going to teach you, so very few people out there are actually teaching. I often feel like some people just hope for the best when they choose stocks or bonds. They don't really know what they're on about with regards to the returns that you can actually expect with each investment. So that's what I'm going to teach you right now. So this is what I learned from Ben Graham and Warren Buffett when it comes to choosing stocks or bonds, okay? So we need to ask, how much will each investment yield? And obviously with bonds, it's pretty simple because it tells you the exact return that you're going to get with your investments. For example, the current 10-year Treasury bond rate is 2.457%, and the current 2-year US Treasury rate is 2.286%. So yeah, bonds is pretty easy, but now we need to get to something that is a little harder, which is the expected return on stocks at the moment. And to be honest, it's actually not that hard to work out the return that we can expect to get on a stock. So what we need to do to work this out is we first need the PE ratio of the entire market. And to find this, you just got to type in on Google the S&P 500 PE ratio. Then click on this link that is over here, and it says right here that the PE ratio at the moment is 21.8. Now what we need to do is get the inverse of the PE ratio, and to do that we just divide 1 by 21.8 and we get a 4.9% return. So that's based on the price you pay and the earnings that we get in return for the price that we pay. Now the one thing that is missing in this equation is growth, because earnings will obviously grow in the future. And the growth that we can expect, at least for the USA, will be similar to what the GDP growth is, because GDP equates to how much businesses and people are producing in the economy. And the current GDP growth for the USA is around 2.3%. So if we add those two things together, what do we get? 2.3% plus 4.9%. That's 7.2% if my maths are correct. So the expected return that we can expect with USA stocks is 7.2% compared to bonds. The 10-year is 2.5% or the 2-year treasury is 2.3%. So, technically speaking, when we compare the returns between these two groups of assets, obviously we're going to be picking stocks for the long term. But there's a little bit of a caveat, because you might rightfully ask the question, if there is going to be a stock market crash, shouldn't we just wait for the stock market crash to happen and then buy stocks? Well, yeah, that is a pretty good question, and this is something that a lot of our value investors have been doing for years. They have put a lot of their money in cash over the past couple of years, waiting for that crash, waiting to buy stocks when they are cheap, and unfortunately, that just hasn't happened. Actually, the stock market has been going very well over the past, 4 years. So, that's the thing. If you're going to choose to play the waiting game in cash, waiting for a crash, you might be waiting a long time. There has been periods in the USA stock market history where the market has pretty much just kept rising for 20 years straight. Maybe the stock market could keep going up. It is a definite possibility. But there is no guarantee that the stock market is going to crash. It is not a definite thing, guys. Especially when we are talking about the USA market. That's the market that everyone trusts, the market in the greatest capitalistic country in the world. And it is for these reasons that I've talked about why I personally am predominantly still buying stocks. Because I know that over the long term, it will offer me a better return than not buying stocks. A lot better return as well, 7% compared to 2%. But yes, I will give you this, of course, 2%, 2.3% return, that is a lot safer. It is completely guaranteed. And that is one reason why I still have some portion of my portfolio in cash, because first, I know this 2% return is guaranteed, and second, if stocks do crash, then I can put this money straight into the stock market when things are cheap. And this is why I'm saying it's a balance between buying stocks and building up a cash/bond/interest on savings position. But personally for me, I'm buying a lot more stocks compared to having it in cash. But, that is just me. Now I want to look at something more important than my opinion, which is what the experts are saying. And we're going to look at 2 investing experts for this example. 2 of the greatest investing experts, I would say, almost. So, the 2 experts that we're going to look at in this video are Warren Buffett and Ray Dalio. We're going to start with Ray Dalio, and we'll finish with the GOAT investor, Warren Buffett. So Ray Dalio's portfolio is what was named by him as the all-weather portfolio, because it is meant to do well in all market conditions, a recession, a flat market, or a bull market. And this portfolio is mainly focused on bonds. It has 55% in bonds, 7.5% in gold, 7.5% in commodities, and 30% in stocks. So if you're a very conservative investor, you could follow what Dalio does and invest a lot of your money in bonds. It's a very safe approach to investing. But Ray Dalio still does buy some stocks, and I remember he said in an interview a year or 2 ago that he is still dancing and dabbling in stocks, but he's just dancing a little closer to the exit doors. So this expert, yes, he is still buying stocks, but his portfolio is very conservative, so it would not matter if stocks crashed, and he is ready at any moment to stop buying stocks. But next, let's move on to Warren Buffett. Now, I love to follow Buffett just to ensure that I'm taking the correct approach with my overall portfolio. And Warren Buffett has said time and time again that yes, he is still buying stocks. Yes, he does have quite a large cash position, but he's still buying stocks, And, he has actually come out in a recent interview and he said this. He said stocks are ridiculously cheap if interest rates stay at these levels. And this is exactly what I've tried to show you in this video. Interest rates are low. If you invest in bonds, you're going to get a low rate of interest return. Compared to if you invest in stocks, your overall return is going to be a lot higher. And that is why Warren Buffett says stocks are cheap compared to the current interest rates. At the end of the day, you do have to put your money somewhere, and stocks, they're the better option because over the long term, they offer better long-term returns. But you should still have a certain portion of your portfolio in safer assets like cash. This way, if stocks go up, you'll still be earning money. And if stocks go down, if stocks crash, well, you'll have cash on hand to snap them up when they are cheaper.